global marketplace. Geoff, how are you assessing the current geopolitical situation that's playing out? And what's the impact like on Indian and emerging markets, in your opinion, to start off?
It's a very complicated question. I argued in the note that I put out a couple of days ago that after the 2025 was the year of AI in the markets, I think the year 2026 is going to be the year of geopolitics. Now, there's so many things that could go on. Imminent attack on Iran, maybe China moving on Taiwan, concerns about the US moving on Mexico or Colombia, and then you've still got the Russia-Ukraine war. So there's so many things going on. But what I will say is that so far the markets have reacted pretty calmly to this. Now, as you mentioned, oil prices are up, and I think that's got something to do with the fact that everybody's now understands it's going to take a very long time and a lot of money to get the Venezuelan oil supply up a lot. And meanwhile, people are concerned that if there is a break in the regime in Iran, that's going to impact oil exports from Iran. Now, what's interesting here also is that the dollar's up year to date, albeit only by about 1% on DXY. And yet emerging markets continue to do well. They're outperforming. They're up nearly 5% on the year. And I think that typically is not associated with a stronger dollar. But I think what's going on here is there's been so much money coming into EM in the latter part of 2025, and that's continuing in 2026. In other words, EM is the flavor of the month or the flavor of the year still. And I think that's going to continue for a while anyway.
Absolutely. Geoff, curious to know how the Japan situation is going to pan out, because that's what's really sort of dictating the global money flow at this juncture.
Yes, I think for the EM, if you like, in the DM space is the money going into Japan. Clearly, the announcement of, or at least the likelihood of an early election, so the Prime Minister can get a true mandate, is something which could lead to a certain degree of uncertainty as to whether she wins or how much she wins by. But at the end of the day, I think the Japanese yen and the market, doing well, and the Japanese yen coming down is basically on the fact that you're going to see substantial fiscal expansion, I think, in Japan. You're going to see some heightened tensions vis-a-vis Japan and certainly China potentially. And I think what that is doing is making the Japanese yen look perhaps a little, obviously pushing at lows. And the stock market likes a weak Japanese yen, and that's why the market's going up.
Geoff, how do you look at the Fed rate cuts going ahead for this calendar year? We had a inflation number which is much lower than expected. You have wage rates which are going up at this point in time. Do you see a rate cut of more than two rate cuts coming in this calendar year?
No, I my call is 2 rate cuts this year, 50 basis points. And I think it was only the other day when we got that better labor market data, the payroll data, and also a pretty good claims number recently, that people said, well, maybe the January rate cut is off the table. And now, of course, with the CPI being a little better than expected, only a little bit better than expected, to be fair, now everyone's talking about a January rate cut. I do think they'll probably cut in January. However, I think it's still fair to say that inflation remains above the Fed's target, and the Fed is going to continue to move fairly slowly, which is essentially what Chair Powell said in that extraordinary video that he released, a 2-minute video a couple of days ago, obviously pushing back on the legal challenge against Fed Chair Powell. He is going to continue to set, and they will continue to set, rates based on the macroeconomic environment. And I think that does point towards potentially a modest easing of monetary policy over the course of this year. But I don't think you're going to see major rate cuts. I think that's very, very unlikely, because what the Fed wants to do here in the face of these extraordinary challenges from President Trump is maintain their independence, make sure the markets continue to believe that they can rely on the Fed to create the right sort of policy to keep inflation low, to get it lower still. And if the Fed doesn't do that, and if it cuts too much, then you've still got the risk, even though it's not happened yet, of the bond market deteriorating as the bond vigilantes come back because the fiscal deficit is so high. So I think the Fed will move cautiously, and the US economy is okay in 2026. And so for me, 50 basis points is where we are now. But of course, it's early days, and this swings around all the time, as you all know.
Geoff, it was a pleasure talking to you today. Thank you very much for joining us today.
Thank you.